Usually when we talk about a medical diagnosis, there's, this expectation of absolute precision.
Right. It's black and white.
Exactly. Like you
Right.
break your arm, the x-ray shows that jagged white line, and the doctor just points to it. Broken or not broken, it's clean.
Yeah.
But when you look at the global economy right now, I mean, everyone is trying to figure out if we are booming, busting, or just coasting.
Yeah.
And the standard economic x-ray machines just feel like they're malfunctioning.
They're definitely giving mixed signals lately.
So today, we are pulling out a very specific, highly accurate diagnostic tool just for you. We are looking under the hood of a 130-year-old industrial manufacturing giant.
Okay. I like where this is going.
We're talking about Lincoln Electric. Specifically, we're doing a deep dive into their Q2 2026 earnings presentation and the official Q2 news release.
And, welding equipment and industrial machinery might seem like kind of like background noise compared to all the flashy tech stocks out there.
Yeah.
But they are the literal glue of the global economy.
Really holding things together.
Yeah, exactly. I mean, if a bridge is being built, a pipeline is being laid, or heavy machinery is being assembled anywhere on Earth, Lincoln Electric is likely supplying the tech to do it.
Right.
And because they operate 71 manufacturing facilities across 20 countries, and they sell into over 160 countries, their financial performance isn't just about them. It's a direct reflection of broader macroeconomic trends.
Which is exactly why their ability to generate cash in this incredibly volatile environment is so fascinating. So let's just get straight into the headline numbers because they're staggering for a legacy industrial company.
You really are.
Q2 net sales hit a record $1.22 billion.
Wow.
Right? That is a 12% increase year over year. And their organic sales, meaning growth excluding any acquisitions, were up 10.1%.
That's massive.
We're also looking at record adjusted earnings per share of $2.93, which is up nearly 13%.
Mm-hmm.
And then there's the cash. They generated $254 million in cash flow from operations. That's a 76% jump from the prior year.
Those figures represent a company operating at, absolute peak efficiency. But the metric that truly stands out in the news release isn't even the top-line revenue. It's their profitability.
Oh, I'm glad you brought that up, because this is where I really have to push back on the standard economic narrative.
Okay, how so?
Well, we live in a world where every single company is complaining about inflation, right? Supply chain bottlenecks, rising labor costs, just eating into their bottom line.
Sure, it's the standard excuse right now.
Right. Yet Lincoln Electric reported a record adjusted operating income margin of 18.4%. They actively expanded their profit margins by 0.5%, or 50 basis points.
Yeah.
How does an industrial manufacturer that relies heavily on raw materials and blue-collar labor actually widen its margins in this climate? I mean, it doesn't make sense.
Well, it's by executing this massive squeeze on two fronts simultaneously. They're using volume leverage and just ruthless working capital management.
Okay, break that down for us.
So the volume leverage piece is straightforward, but really powerful. They are simply pushing more product through their factories.
Right.
When you have massive fixed costs, like the overhead of running a huge manufacturing plant in Ohio, for instance, and you increase the number of welding machines rolling off the line, the cost per unit drops.
Because the rent stays the same, basically.
Exactly. That naturally boosts your margin. But the earnings release also highlights a specific 22% incremental margin, and that's driven by improved cost management and their pricing actions taking hold.
So they are pushing through price increases to their customers while simultaneously optimizing their own factory floors to keep their costs flat.
You got it. That combination is what drives the profitability. But to really understand their operational efficiency, we have to look at the cash conversion rate.
Right, which they reported at an astonishing 138% for Q2.
Which is just wild.
Converting 138% of your net income into actual free cash flow, that means they are somehow extracting more cash than their actual bottom line profit.
Yeah.
In heavy manufacturing, growth usually sucks up cash, right? Because you have to buy tons of steel and components to build the inventory before you ever see a dime from the customer. So how are they bleeding that much cash out of their working capital?
By essentially refusing to act as a free bank for their supply chain. The data shows they managed to decrease their average operating working capital to net sales ratio down to 16.9%.
Okay, so mechanically, what does that actually mean?
It means two things are happening. First, they're turning their inventory over incredibly fast. They aren't letting, $50 million of steel wires sit in a warehouse gathering dust. They're converting raw materials into finished goods and shipping them out the door immediately.
Makes sense.
Second, they are likely cracking down on receivables.
Collecting the money faster.
Exactly. They're collecting from their customers much faster.
Yeah.
When you combine lean inventory with rapid cash collection, your on-paper profits convert into spendable cash in the bank at an accelerated rate.
That is the ultimate flex for a manufacturing company. You aren't just wealthy on an accounting ledger. Your bank account is actually overflowing.
Right.
But if they are operating that lean, we need to look at where this is happening geographically because the consolidated numbers are kind of hiding a massive divergence here.
Well, absolutely.
When you dig into the segment data, the growth is wildly uneven. Let's start with the powerhouse, the Americas Welding segment. This group brought in $774.4 million in sales, up 11.2%.
That's huge.
And their margins jumped to 19.7%. According to the presentation, this was driven by a 7.1% jump in volume.
Yeah, and that volume jump is the engine of the entire earnings report. A 7% increase in physical goods moving out the door tells us that in the Americas, companies are aggressively, actively investing in physical infrastructure.
So it's real growth.
Exactly. This isn't just inflation padding the numbers. This is real demand for capital equipment to build factories, repair bridges, expand manufacturing capacity.
And they also benefited from the partial impact of their Q2 2026 price actions. Plus, they were aided by some tariff refunds, so the Americas are booming.
Right.
But then we cross the ocean to the international welding segment, and it's a completely different reality.
That's rough.
Sales grew 4.5% to $243.3 million, but their organic volume actually shrank by 4.7%.
Right.
The only thing that saved their total growth was the alloy steel acquisition, which added 7% to their top line, and their margins dropped significantly, down to 10.6%.
Yeah, this divergence is just a perfect illustration of the fractured global economy right now. The international segment's organic decline actually masks a somewhat nuanced picture.
How so?
Well, they saw volume growth in the Asia-Pacific region, but that growth was entirely swallowed up by severe slowing trends in Europe, the Middle East, and Africa.
That margin drop is brutal, though. We talked about volume leverage expanding margins in the Americas. Is this just the exact opposite happening in Europe?
It is textbook negative volume leverage. Think about those European manufacturing facilities. The rent, the machinery leases, the baseline utility costs, those are all fixed.
Right.
So if demand drops by nearly 5%, you were running those factories below their optimal capacity. You still have to pay to keep the lights on and the core staff employed, but you have fewer products to absorb those fixed costs.
So your profit margin per unit gets absolutely crushed.
Exactly, which is why we saw that sharp 210 basis point drop in their international operating margins.
And the slide deck also specifically called out a $2 million impact from the Middle East conflict. It's easy to read that as just like a line item on a spreadsheet. But in the context of industrial welding, that likely means a desalination plant or an oil refinery project or a major pipeline was just abruptly halted.
Yeah, the welders are sent home, the equipment orders are canceled.
Right, and that macro geopolitical event instantly hits the balance sheet in Cleveland, Ohio.
The interconnectedness of industrial capital flow is just immediate. When instability flares, heavy capital expenditures hit the brakes.
Okay, so we have the Americas booming and international struggling with negative leverage. But the third segment, the Harris Products Group, looks like a mathematical anomaly.
Oh, this one is fascinating.
Their sales jumped nearly 27% to $201.9 million, but their volume dropped by 8.2%.
Yeah.
That is like a car dealership selling 8% fewer cars this quarter. But their total revenue somehow jumping about 27%? How is that possible?
Well, to use your car dealership analogy, it simply means they dramatically raised the price of the cars they did manage to sell. If we look at the segment breakdown, the pricing for the Harris Products Group jumped by a staggering 34.2% year-over-year.
Wait, a 34% price hike in a single quarter?
Yep.
That sounds like pure price gouging. How do they retain any customers with that kind of pricing shock?
They retained customers because it wasn't a profit grab. It was a pure pass-through of massive commodity price spikes.
Oh, interesting.
Yeah. The Harris Products Group specializes in brazing and soldering alloys, which are critical for HVAC systems and industrial plumbing. And these alloys are heavily reliant on silver.
Okay.
Silver isn't just a precious metal, it is the most electrically and thermally conductive metal available, making it completely non-negotiable for these specific industrial applications.
So when global silver prices spike, Harris has no choice but to literally rewrite their price sheets overnight just to cover their raw material costs.
Exactly that. The underlying volume, the actual physical demand for their soldering and brazing products shrank. The company noted tough prior year comparisons in their retail channels and a slowdown in the HVAC market.
But the revenue skyrocketed purely because the silver required to make those products became wildly expensive.
Exactly.
That completely flips how we usually interpret financial headlines. I mean, we naturally assume massive revenue growth means a business is capturing market share and winning more customers.
Right, that's the standard assumption.
But here, the top-line revenue growth is just an inflation mirage. They are actually selling less product, but surviving a severe supply chain shock by passing the inflated bill directly down the line.
It is a really critical lesson in reading earnings reports. Top-line revenue tells you how much money changed hands. Volume tells you how much work was actually done.
So if we step back and look at who is actually buying all this equipment despite these crazy price hikes, it gives us a real-time heat map of global capital deployment.
It really does.
The earnings presentation breaks down their global end sector performance, and 4 out of their 5 end markets are growing.
Yeah, the growth is broad-based, but the variance in how fast these sectors are growing tells a really fascinating story about the 2026 economy.
Let's run through it. Heavy industries and non-residential structural steel are up mid-single digits, which tracks with the factory boom we discussed. Energy is up low single digits, but general fabrication is exploding up mid-30%.
Massive jump.
Meanwhile, transportation is the lone loser, down mid-single digits. Why is general fabrication up an incredible 30+% while transportation is shrinking?
Well, general fabrication represents the day-to-day metalworking that supports local economies. It's, local job shops, metal furniture fabrication, light industrial equipment. A mid-30% jump there indicates incredibly robust, widespread industrial activity, primarily in the Americas.
So the smaller guys are busy.
Right. It means the small and medium-sized businesses are buying equipment and running their shops at full tilt.
It's the everyday industrial backbone just firing on all cylinders. But then you have transportation moving in the exact opposite direction.
Yeah. And transportation being down mid-single digits is a classic leading economic indicator.
Okay, why is that?
Because this sector includes automotive manufacturing, shipbuilding, rail cars. Heavy transportation equipment is what moves the goods that the rest of the economy produces.
Oh, I see.
When transportation manufacturing cools off, it often signals the bullwhip effect in logistics. Companies are looking at their supply chains and deciding they don't need to order as many new train cars or heavy trucks because they anticipate the movement of consumer goods slowing down.
Wow. So it really is a tale of two economies. We are aggressively building the physical infrastructure, the factories, the structural steel, the local fab shops, but the heavy assets required to move finished goods around the globe are hitting the brakes.
Exactly. The capital is flowing into production capacity right now, not logistics.
If that's the reality on the ground with international volume shrinking and transportation logistics cooling off, I have to severely question management's guidance for the rest of 2026.
Oh, their guidance is bold.
Because they aren't bracing for impact at all. They actually upgraded their net sales growth assumption for the year, moving it from a high single-digit percentage to a low double-digit percentage. How did they justify projecting double-digit growth with so many underlying volume headwinds?
Well, management is being highly transparent about the mechanics of this upgraded guidance, and it leans heavily on their pricing strategy. They explicitly break down the mix for this future organic growth, projecting that only 1/3 of the growth will come from actual volume increases.
Only a third.
Yeah. The other 2/3 will come entirely from price.
Wow. They are openly telegraphing to investors, we expect to make more money mainly because we are charging more, not because we are selling a massive influx of units. Are they just banking on inflation lasting forever?
They're banking on their own pricing power, which is really the ultimate shield for legacy industrial companies right now. I mean, if you manufacture a highly specialized automated cutting system or a proprietary welding rig that a factory absolutely needs to operate, your customers will grumble about a price hike, but they'll pay it.
Because they have to.
Right, they have no alternative. Lincoln Electric is betting that their technological moat is deep enough to sustain these price increases without destroying demand.
And it seems investors are thoroughly enjoying the strategy because the cash isn't just sitting in a corporate treasury account. The capital allocation slide shows they returned $120 million to shareholders in Q2 alone.
Not bad at all.
That breaks down to $43 million in dividends and $76 million in share repurchases.
Returning capital is always popular, but for anyone evaluating the long-term competence of a management team, the most critical metric in this report is their adjusted return on invested capital, or ROIC.
Right.
They hit 23% this quarter, which is a 130 basis point improvement from the prior year.
To put that 23% ROIC in perspective, you usually see software as a service companies boasting about 20+% returns on capital because they just write code and sell subscriptions.
Exactly. Their overhead is tiny.
But for a 130-year-old metalworking company that has to buy steel, run massive factories, and pay thousands of union workers to achieve a 23% return, that is wildly difficult. It means for every dollar they invest back into their business, they are generating 23 cents in operating profit.
It proves that their internal investment framework, which they call their RISE strategy, is highly effective. They aren't throwing money at inefficient factory upgrades or buying up terrible companies just to show revenue growth.
Right, they're being smart.
Very smart. When they invest capital, whether it's automating a specific production line to reduce labor costs or acquiring a strategic asset like alloy steel, that money is generating a massive tangible yield.
But they are also realistic about the threats to that yield. The earnings presentation outlines specific risks they are monitoring, including the net impact of trade and regulatory policies and ongoing inflation across raw materials and labor.
Which makes perfect sense.
Yeah, especially given we just saw a 34% price hike in Harris products, entirely driven by the silver market.
The commodity markets are unpredictable, and any sudden spike in base metals will force them to test that pricing power all over again. But they also list opportunities that are not currently baked into their double-digit growth assumptions.
Like what?
These include potential acquisitions and, quite notably, a Middle East ceasefire.
Which brings us right back to that $2 million international hit. It's a stark reminder that this company is a living, breathing component of the global machine.
Yeah, analyzing a company like Lincoln Electric really grounds our understanding of the macroeconomy. It strips away the abstract economic theory and replaces it with actual steel, silver, and operating margins.
It proves that old economy industrial machinery companies, as long as they have genuine pricing power and ruthless working capital management, can still print massive amounts of cash. I mean, they can generate a 138% cash conversion rate and a 23% return on invested capital, even while navigating international conflicts, shrinking European volumes, and wild commodity spikes.
Industrial resilience is very real if the management team knows how to pull the right levers.
And that leaves us with a final thought to ponder. We saw how Lincoln Electric explicitly listed a Middle East ceasefire as a direct business opportunity that could instantly boost their future earnings by unpausing major capital projects. Concurrently, we saw how a spike in a raw material like silver drove a 34% price jump in a single business unit almost overnight. Two completely different external forces, geopolitical diplomacy and raw metal markets, both immediately hitting the balance sheet.
The macro always finds a way to physically manifest in the micro.
It begs the question, as geopolitical conflicts either resolve or escalate in the coming months, and as supply chains frantically react, how rapidly will we see those macroeconomic shifts ripple through the pricing of the everyday manufactured goods all around us?
It's something to watch closely.
We often think of global events as abstract news on a screen, but when you look closely at the data, you realize that foreign diplomacy and commodity traders are quite literally dictating the price of the metal chair you might be sitting on right now. Hopefully, this custom deep dive gives you a new lens to view the everyday objects around you. Thanks for listening.